Welcome to Spiedel's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering the tax ramifications of claiming a theft loss deduction for stolen cryptocurrency. Sign up for Spiedel's 2025 Summer Tax Webinar and get a mid-year refresher that will cover maximizing profitability in your tax practice, reporting real property transactions, and more. Get details on this 8-hour webinar at spiedel.com. One of the largest financial thefts in history occurred earlier this year when a North Korean group hacked into Bybit, a cryptocurrency exchange based in Dubai, and stole the equivalent of $1.46 billion in Ethereum tokens. But stolen cryptocurrency is often recovered due to the breadcrumb trail of transactions that are left behind in the blockchain ledger, allowing investigators to track the funds from wallet to wallet and across exchanges. This leads to an interesting tax ramification for cryptocurrency holders who are victims of theft. If the stolen cryptocurrency is returned to them after the taxpayer had determined that there was not a reasonable prospect of recovery and claimed a theft loss, it could create a taxable event. In the event that investment property such as cryptocurrency is stolen, a taxpayer can claim an ordinary loss deduction equal to the adjusted basis of the property minus insurance or other compensation received or recoverable. For cryptocurrency, this would generally be the amount the taxpayer paid for it. Taxpayers can deduct losses sustained during the taxable year that are not compensated for by insurance. For taxable years 2018 through 2025, losses are limited only to losses sustained in a presidentially declared disaster. However, the loss limitation for taxable years 2018 through 2025 does not apply to casualty and theft losses from business property, income-producing property, and Ponzi-type investment schemes. Considering how much the value of cryptocurrency has risen over the years, the theft loss deduction, which is generally based on the price originally paid for the cryptocurrency, could be negligible compared to the amount the taxpayer could receive if the cryptocurrency is recovered, which will reflect the cryptocurrency's fair market value. Also, taxpayers should evaluate whether it makes sense to claim a theft loss deduction in light of any potential recovery of funds. After a taxpayer takes a theft loss deduction for stolen cryptocurrency, if the property is recovered, it is treated as a taxable gain as if the cryptocurrency had been disposed of. If the taxpayer did not take a theft loss deduction and the cryptocurrency is returned in its original form, there is no taxable event unless the taxpayer receives the cash value of the cryptocurrency, which may be taxable income. As an example, assume that a taxpayer bought 3 bitcoins in 2020 for $15,000 each. The taxpayer's basis in the bitcoins is $45,000. In 2025, when the bitcoins are worth $100,000 each, they're stolen. The taxpayer can take a theft loss deduction of $45,000, even though the bitcoins were worth $300,000 at the time of the theft. If the taxpayer took the deduction for the 2025 tax year, but then the bitcoins were returned in 2026 when each bitcoin was now worth $120,000, the taxpayer would owe tax on $360,000 of ordinary income because the taxpayer is treated as if they had disposed of the bitcoin due to the deduction claimed in the earlier year. Had they not claimed the theft loss deduction, there would be no taxable event because they recovered the actual bitcoins. Instead, if as part of the recovery of the stolen bitcoins, the exchange paid the taxpayer the value of the bitcoins in cash because the theft was caused by a breach of their system, and the taxpayer received $360,000 in 2026, the taxpayer would report $315,000 in capital gains, the value of $360,000 minus the taxpayer's $45,000 basis. At Spiedel's quarterly federal tax update webinar, you'll get all the news you need to keep your clients current, as well as new tax planning strategies to minimize taxes throughout the year. Sign up for the series of 4 webinars or just a single session at spiedel.com. That's all for this week. Join us next time for another episode of Spiedel's Federal Tax Minute.